Good morning. It's Jeffrey Christian of CPM Group. It's about 10:15 in the morning here in New York on Friday, the 6th of February. I want to talk about several things. I'll talk about the markets first, but I'll talk a little bit about COMEX margins and JPMorgan and a gold standard and copper, responding to some comments from a recent video that we did. First off, gold prices rose to a record level. They shot up very sharply in January, got to this record level of over $5,500, came down very sharply last Friday, the 30th, the first delivery day for the February COMEX gold contract, and the day when Kevin Warsh was nominated to be the Fed chairman, and various other factors were going on. Price has been trading between 4,500 and 5,000 over the course of this week. It's consolidating. CPM Group expects the price to continue to be volatile because the economic and political factors behind the rush of investors globally into gold and silver and other metals continues. Those problems that have caused people to buy tangible assets, especially gold and silver, they're still in place, and they will probably continue to assert upward pressures on prices. That said, the price has risen very sharply since last August, at the end of last August, and it remains vulnerable to declines, such as what we saw this week when the price came down below $4,500. I put in a couple trend lines here to show you that the price can go down to $3,750 and still be in an upward trend, a short-term upward trend line. It can go down to $3,300 and still be in a upward trend line that extends back to the beginning of 2024. And the longer-term upward trend line since 2019 is even lower. So gold, in our view, is going to continue to rise in the long run based on fundamentals within the gold market, strong investment demand, and that investment demand in turn is driven by a host of political and economic and social problems, not only in the United States, but on a global basis, that continue to drive prices higher. That said, there's a great volatility, a lot of uncertainty, and people are constantly reassessing the risks to their own financial and physical well-being. And you can see prices spike down lower. We don't think it's going to get to 3,750. I wouldn't be surprised to see a spike down to 4,000. But the reality is that in our view, the risk-reward ratio is heavily skewed to reward, and you're much more likely to see higher prices in the long run than lower prices. Now, that said, if you're going to see another spike down, it could occur in the next 2 weeks. There's certain timing that goes on in the commodities trading world that could do that. In addition to that, you've seen the Trump administration back off from some of the things that have been scaring people. They sent a lot of ships into the Arabian Sea. They were threatening to start an all-out war with Iran. They've kind of backed off from that, but not really. They've backed off from attacking NATO land and invading Greenland. They kind of backed off from invading Panama and Cuba, other targets that they had talked about. They're also backing off in Minneapolis. I think all of that's temporary, but on a temporary short-term basis, it could lead investors to say, let's take a little bit of profits. Maybe things are getting better. Our expectation is that they are not getting better in the longer run, and the prices will move higher over the course of the second half of February, or over the course of February and March. We'll have to wait and see what happens in the second and third quarters. Our view of silver is very similar. Again, you can see those short-term trend lines. They have, support at $30 and $40 an ounce. Could we see a spike down that low? Yes. Do we expect it at CPM Group? We don't expect to see $30 in the near term. I wouldn't be surprised to see another spike down in the first half of February before the price rises in the second half of February. Our expectation is that the price will rise in the second half of February and then probably come off again in March, again for a variety of factors that we're looking at. So again, the risk-reward ratio, short term, there's this risk here. And if you look at the ETF, say net additions and subtractions in January, over the course of January, in all but 4 of the trading days, there were 22 trading days in January, and in 18 of those days, investors were adding to their gold ETF holdings, and in only 4 were they net sellers. In silver, they added to their net holdings 5 days, and they were net sellers 17 days. And they sold an enormous amount of money as the price of silver rose from $90 to $121 in the Monday through Thursday of last week, the last week of January. And then they sold an enormous amount on Friday. They sold a lot on those 4 days as the price was rising. And when the price went from $121 to $72 on Friday, they bought back like 5 million ounces. But investors in silver have been much more opportunistic, and that's probably going to continue. Platinum prices, similar pattern. Again, there is some support. We didn't bother to draw trend lines because they're kind of like silly, because the upward trend only started in June of last year. But you're seeing stronger support at a higher price. There's a lot of people who are becoming more bullish on platinum and palladium use in auto catalysts, and that's supporting the market. You're also seeing some reductions in platinum and especially palladium production in North America. And you're continuing to see headwinds in the South African platinum industry, mining industry. Palladium prices, very similar pattern. A little bit more bullish views on palladium because it's used in passenger vehicles that burn gasoline. And that is continuing to recover a little bit of market share, at least in the United States, from electric vehicles. And platinum and palladium are also used in hybrid vehicles, or what is now being called alternating power vehicles. And so what you're seeing in Europe is a shift away from battery electric vehicles purchases to hybrid vehicles, alternating power vehicles. And that is seen as being bullish for platinum and palladium. They actually use more platinum and palladium and rhodium in the catalysts for hybrid vehicles because they have the start and stop cold cycle. So they require more metal than conventional internal combustion engine vehicles. Now I want to respond to 3 comments. The first comment was from Jaguar, I guess. Why did the COMEX raise its margin rates, and why did JPMorgan dump a huge load of silver shorts at the bottom of the range? Well, okay, first, COMEX raises margin rates when the price rises in order to assure that every long and short in the market has the financial wherewithal to meet its financial commitments, to deliver if it's short and to take delivery if it's long at present prices. So as the price rises, the need for more margin to assure that these people have the financial wherewithal to hold those positions increases. That is why there are not defaults in the market. Now, the COMEX clearinghouse deals with registered participants, futures and futures commission merchants, futures traders, companies that actually trade on that. And the futures commission merchants, they process trades for their clients. And they are responsible under CFTC rules and under exchange rules and under clearinghouse rules to make sure that their clients had deposited sufficient assets to meet their financial requirements for both shorts and longs. So the COMEX raises margin rates in order to assure the financial and creditworthiness, stability of market participants, not to suppress prices. If you think they do it to suppress prices, you need to go back to school. You need to go to the library and get some basic books on financial markets, because margins and margin accounts are required across financial markets, and not to suppress those prices, but to assure the credibility and stability of the trading in those markets. Now, JPMorgan actually did not dump a huge load of silver shorts at the bottom of the range. In fact, nobody did. I'll show you some data in a second. But the thing is that people don't realize JPMorgan is a futures commission merchant. Other people don't realize JPMorgan runs a depository and charges people and companies that want to store their metal in that depository. Okay? The metal in the JPMorgan depositories in London and New York and elsewhere is not JPMorgan's metal. Some of it is, but most of it is actually other people's metal, and JPMorgan charges a depository storage fee if you want it on an allocated basis. If you don't want it on an allocated basis, they won't charge you that fee. And then it's a deposit, just like cash. When you deposit money in a bank, you are giving your money to that bank. You no longer own that money. You own an IOU that the bank says, hey, thanks for giving me that money. And you want it back, I'll give it back to you. And if you're holding metal on an unallocated account, you're doing the same thing. You're saying, here's my metal. I don't want to pay you the storage fees, but I may want the metal back. And that metal then belongs to the bank on an unallocated basis. That's why in 1998, when we wrote a report, letter to the World Gold Council, and we said, you guys have been promoting jewelry, but if you want to see higher prices, you should be promoting investment demand. And in order to promote investment demand, what you need to do is have an ETF, an instrument that trades on stock markets, that buys physical gold and holds it on an allocated basis. Pay a storage fee, but it's yours, and it cannot be hypothecated. Similarly, in 1996, 1997, when Berkshire Hathaway bought a lot of silver, 129.7 million ounces of silver, it bought it and took delivery of it and held it on allocated accounts. They actually moved the silver outside of the London LBMA depository catchment area to depositories that were further away from London, so that not only was it allocated to them and could not be used for leases and other hypothecations by their financial intermediaries, but it also was out of the sight of people going to those depositories in London and seeing the metal. We have held metal for clients at various depositories around the world for decades. And one of the things that we do, which we actually learned from Johnson Matthey, is we have the depositories throw a tarpaulin over the metal that we're storing there, so people can't see how much metal's there or what kind of metal it is. You go for discretion. But JPMorgan is a futures commission merchant, and the trading that you see JPMorgan and other banks do on exchanges, not just gold and silver, but any exchange, the trading that you see is mostly for their clients. They aggregate the buy and sell orders of their clients, and they execute it on the exchange. So when you see large issues and stops and large short sales and large long purchases by individual banks, it's not the bank necessarily doing it for its own account. Most of that is actually for other entities, their clients. And by the way, there wasn't any big dumping of silver shorts at the bottom of the range last Friday. Morgan will charge its clients and say, you've got to top up your margin account to make sure that they have deposited sufficient funds that JPMorgan can assure the clearinghouse that its clients will not default. That's how markets work. And if you think otherwise, you need to go to the library and get some books on markets and financial markets, and not just commodities, but all markets. Or you need to go to night school and catch up on how the world really works. This is actually the silver deliveries for the February contract. And the February contract is not an actively traded COMEX contract for silver. But you can see on the 29th of January, which was the first day when a short can go to the clearinghouse and say, I have short contracts on February. I'm going to deliver into them. You have depository receipts of metal that I own that I've given you, so they're registered with that. You should assign them at random to people who are long February. And on the first trading day, which is kind of common, there were 1,000 sorry about that, 881 contracts. So 9 million ounces in a market with 430 million ounces of stocks and even more open interest. And then, the next day, 633, 5,000 ounce contracts, and it trailed off. So that by the time we got to yesterday, there were 3,744 contracts, representing about 15, 16 million ounces of silver. Not a lot of silver dumped. The shorts, all shorts didn't dump. Now, unfortunately, the COMEX data that breaks it down by actual futures commission merchants, only the stuff that's free data is only available for the previous day. So this is the data from yesterday. And you can see the issued, those are the companies that have short positions that went to the clearinghouse and said, in the case of Macquarie, I have 100 contracts, I'm delivering into them. And then the clearinghouse will assign those to people who are long the February contract. And then you can see the long contracts. JPMorgan's was on the long side, taking delivery of 62 contracts, not necessarily for itself. These are futures commission merchants acting for their clients. And they make money acting for their clients. They take a broking fee from their clients. The same way depositories take a charge for holding metal on an allocated basis. Right? And stop there. If the price of silver is $30, they get, in the case of depositories, we have special deals with depositories, and we can get down to 15 basis points a year of the value of the metal stored in a depository that they'll charge our clients. A lot of depositories are 30, 40, 50 basis points, 0.5% a year of the value. If the price of silver is $30, you're getting 0.5% of $30. If the silver price is $90, you're getting 0.5% of $90. You're getting 3 times as much to be a depository, right? And if you're leasing metal out and you're leasing the metal when it's $30 and you're getting 3%, you're getting 3% lease fee on $30 metal. But at $90, you're getting 3 times as much. That's why JPMorgan and all the other futures commission merchants involved in gold and silver are reporting record profits. Not because they played the market right, not because they were long over the last year as the prices rose sharply, not because they sold massive amounts when the prices spiked down, but because they earn a fee that's a percentage of the value of the metal. Ergo, if you can do arithmetic, you can understand that banks like JPMorgan and all these other guys listed here make more money when the price of gold and silver are high. They have a vested interest in higher prices. For them to suppress the prices would be to act in against their own best interests. Try to tell a judge that these guys are doing things that are hurting their own finances. Or better yet, tell the CEOs. Yeah, it doesn't happen that way. This is gold. Gold, February is an active contract. And on the 29th, you saw 20,000 contracts, 100-ounce contracts, right? So you saw 20,000 ounces, and then it came there, and it's been relatively high. So as of the other end of the day, as of the end of the 4th of February, 5 days into the delivery process, you had 3.2 million ounces delivered, 2 million of which was delivered in the first trading day. That's the standard pattern across commodities markets. And again, you can see here, this was from a couple days ago. I don't want to belabor the point. I put this in here because I wanted to show off my Olivetti Studio manual typewriter from the 1970s. This is when I worked as a journalist and I traveled around and I'd type in hotel rooms and I'd go off into cabins and write. And I just like it. But I want to show you these two bills, and I'll show them to you on Class Up Bacon, but I wanted to show off my typewriter. The top bill is a U.S. Treasury note issued prior to 1971, and it's actually a silver certificate. You might be able to see at the very top, it says silver certificate. So it was redeemable for an ounce of silver back in the 1960s and earlier when the Treasury had its bills, its certificates, some of its certificates backed by silver. You could go to a national bank and say, I have silver certificate for $1. Give me an ounce of silver. Those are Treasury notes. We stopped issuing Treasury notes when we went off the gold standard in 1971. And since 1971, the Treasury has not issued notes. The Federal Reserve Board has issued notes. So at the bottom is a Federal Reserve note. Now, this is very important to understand when I respond to this next question. This guy, Goody Two, said, as far as the U.S. dollar, Dr. Art Laffer, creator of the Laffer curve, was one of blah, 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 said that the U.S. dollar must be hinged to something tangible and gold should be part of it. I'm going to tell you an anecdote. In 1980, Art Laffer was an advisor to the Reagan campaign. And he said, Laffer curve, supply side economics. You can cut taxes to the wealthy and to corporations, and the ensuing economic growth will boost government revenues and get rid of that $58 billion a year deficit that we've been running, and will turn surpluses. That was wrong. And ultimately, he cut taxes, he raised defense spending, and the deficit went from $58 billion to $350 billion in a couple of years under Reagan. But Art also crafted a gold standard plank for the Republican platform in 1980. And I got together with him at a conference for hard money people and took him out drinking afterward. And I said, so what's the gimmick? He said, this is the deal. Our plank says that the Treasury will have a 40% gold backing for all of the Treasury notes it issues, but it doesn't include Federal Reserve notes. We haven't issued Treasury notes since 1971. So we can say we're going to a gold standard and Treasury notes will be backed by gold. And then we can print Federal Reserve notes till the cows come home. People will like the dollar because the dollar was under pressure in 1980. People will like the dollar because it's backed by gold, not realizing that the Federal Reserve notes that we're issuing, that we're living on, are not backed by gold. That's how honest and ethical that's how corrupt and cynical Art Laffer was, as well as the Republican leadership at the time. Needless to say, I was still a journalist, so I wrote an article about it. So when you tell me that Art Laffer says we should have gold backing for the dollar, I say, yeah, right. I've heard that story. I've heard that lie. It usually is accompanied by the tinkling of a piano someplace. I don't care what Art Laffer says because he has always been wrong and he's always been deceitful. So you stick with Art Laffer, Bubba. And the third one, what would you... Oh, this guy said that there were some inaccuracies in our presentation because we said that people had rushed into copper and then dumped it, but there was no correction in copper. The copper price fell 16% in one day last week. It was $6.58 at the top of the morning, January 30th, Friday, and it was $5.56 by the end of the day. 16%. I would call that a correction, but who am I to say? All right. Next week, we may not have videos. Carlos Sanchez and I have work elsewhere that may prohibit us having the time to produce videos. We may produce some videos that are less time sensitive. We're talking about one about central bank gold and the growth, the movement from secret central bank activity, not just in gold, but with everything, from secrecy to transparency. It's a trend that occurred throughout central banking, starting really in the early to mid 1980s when Paul Volcker was the Fed chairman, and then progressing, and the Bank of England and the Swiss National Bank were very much powerful in it. And it also included gold. And I may try to do a video that sort of explains that transition and what was going on, really from like 1989 with the Maastricht Accord that said January 1st, 1999, we will have a euro and we'll have a European central bank. And during that period of time, central banks in Europe were selling a lot of their gold and not reporting it publicly because, well, they would report it to the IMF with a lag. And they would do various other things to mask it. There was this secrecy about it. And that was because if a central bank needed gold, needed money to support its currency, it needed US dollars to buy that currency and support it. And the US dollar market was the most liquid currency market around. If it had its reserves in gold, and most central banks in Europe had most of their reserves in gold, then you had to go into a relatively thin gold market where all the banks would see you coming, sell your gold. They knew why you were selling gold because you needed dollars to buy your currency. So they would front run you and they would buy your currency knowing that you were selling gold in order to get dollars to buy your currency. Bank of England, the Swiss National Bank, the U.S. Federal Reserve Board, they were all saying, we got to be more transparent, not just with gold, but also with other things. And we want to get out of the rumor mongering that was occurring in the gold market. I may talk about that in a video if I have time today before I get caught up in this other project. But we may not have videos next week. If not, we'll be back the week after that. We will be having our Silver Facts and Fantasies online seminar. It'll be February 26th. I believe that's a Thursday at 10 a.m. It is open to the public. We started this in 2021 when the pandemic lockdown had led to cancellation of the Prospectors and Developers Association of Canada annual meeting, and we replaced our silver reception there with this Silver Facts and Fantasies online seminar. It was so popular that people asked us to continue doing it, and we've done it ever since then. We haven't posted the registration on our website yet. We'll get to that, and that is coming up, as I said, 26th of February. The second quarter 2026 open forum for clients, the open question and answer period, will be on the 22nd of April at 11 a.m. Eastern Time. And then we have our gold, silver, and platinum yearbooks coming up. And then we still have this special report that you can buy that Silvercorp helped us produce, subsidized, and it's the Gold and Silver Renaissance 25 years on, talking about our long-term views toward gold and silver. They're really, an extension of our views that we formulated and label a renaissance in investment demand and ergo prices in October of 2000. That's all I have for now. You can go to our website. We'll get that Silver Facts and Fantasies posted later, soon. You can pre-order our yearbooks for this year. You can order last year's yearbooks. You can subscribe to the Precious Metals Advisory Monthly Report. You can sign up as a retail investor client to get research from us. You can buy our long-term reports. We've just updated our long-term gold and silver supply, demand, and prices for the next 10-year projection. You can send us a note at info@cpmgroup.com saying you want some of our research or you want to talk to us about consulting services. That's all I have for now. Take care. Take care of yourself. Take care of those around you. Do something good for the world. And if you're in the Northern Hemisphere, especially in North America, stay warm. And we'll talk to you when we're back.